on for the
Oil prices have entered a phase of cautious stability.
As investors across the globe weigh two opposing forces, the risk of sanctions tightening supply and the fear of oversupply flooding the market.
In recent days, global benchmarks like Brent Crude and West Texas Intermediate have shown little movement, hovering around $64 and $6 per barrel respectively. The market seems unsure, caught between political uncertainty and economic realities.
On one side, new U.S. sanctions on Russian energy giants like Lukoil have raised alarms. These restrictions are meant to limit Russia's oil exports, potentially squeezing global supply and pushing prices higher.
But so far, the actual disruption has been limited.
Tankers continue to move, and Russian crude still finds its way to buyers, though often at discounted rates. But so far, the actual disruption has been limited. Tankers continue to move, and Russian crude still finds its way to buyers, though often at discounted rates.
Meanwhile, OPEC Plus nations continue to pump more oil. In December alone, production increased by nearly 137,000 barrels per day, and more output is expected in early 2026.
Across Asia, crude storage has doubled in recent weeks, a clear sign that supply is outpacing demand.
This delicate tug-of-war between sanctions and oversupply has left oil prices trapped in a narrow band.
The market is waiting for something decisive, a major policy shift, a production cut, or a spike. For energy importing countries like Pakistan, this temporary stability offers short-term relief. But if sanctions begin to bite harder, or if supply chains tighten, oil prices could quickly rebound, pushing domestic fuel costs back up. The global oil market stands at a crossroads. Too much supply could sink prices. Too many sanctions could send them soaring. For now, the balance holds. But in a world of shifting geopolitics, that balance could break at any moment. For now, the balance holds. But in a world of shifting geopolitics, that balance